Let's talk some shop here, huh? So tomorrow we have Mr. Powell. We also have some inflation numbers coming out, the PCE deflator coming out in the morning, I think it's pre-Powell. So you got some interesting stuff that we're going to hear tomorrow. This market reaction today and into the bell is just simply a spit in the Fed's face. And, you know, we were talking about it a little when I got back today in the room. And for those who are members, that Goldman Tony P piece, I have it pinned to, I have it pinned to private Twitter, who anybody didn't get a chance to read it this morning. He talks, where is it here? Let me just find it. Oh, right here. So number 8, he talks a little bit about kind of what we were looking at. If you remember the last webinar, we were talking about what we've seen already has been short covering, significant rally, the setup was there, but even a bigger takeaway than the actual squeeze, because again, the catalysts were there for the squeeze. It had to get lit, and then not only lit, we had to see how the Fed and their tools would react to the squeeze. And this is what Tony P talks about here in number 8. Okay, and it's, again, that's why I'm a big fan of Tony P. A lot of what I talk about, a lot of the way I look at the market is very similar to the way he looks at the market. We notice and acknowledge very similar things. This is one of the things we've been talking about in prior webinars, and I was going to talk to you a little bit about today. And simply what this all says here, number 8, and again, if you remember, you can go read the whole thing, it's worth it, is that prior rallies, the Fed has utilized their tools, or I guess the better way to put it, guys, because it's not like tools they physically could put to work. A lot of this stuff in regards to easing and tightening financial conditions comes via the Fed's mouthpiece, right? In what they say. And then the market tries to price that in, right? So what I mean is, like, if Powell is super hawkish and the market interprets his language that way and believes it, okay, you're going to see financial conditions tighten in the market. And what that means, you're going to have risk assets like equities, Bitcoin, anything speculative, see some weakness. Okay, you're going to see credit spreads start to widen out, okay, which also has an effect on risk assets and equities. So the market's interpretation of what the Fed says and does via interest rates is how financial conditions are moved around, either in the easier direction or tighter direction, okay? And here's a good chart you guys could see. I could flip around a little, even though I'm not too good at it, but I'm going to attempt it here. Okay. All right, so you see this is basically everything, kind of what we talk about that go into financial conditions, okay? This is the indicator. So financial conditions in an indicator form. Again, Bloomberg provides one. Goldman provides one that's very popular. This one, I think, is out of Mizuho, which I like because it shows the other components. So you see this, just this little move here, okay? That allowed the recent squeeze from the lows that was nice, beautifully set up because of extreme bearish positioning, which we spoke about. It allowed that rally some breathing room to run its course. Okay, that little move here. All right, and what a lot of us were worried about was not necessarily the squeeze getting set off, because again, you had hedge fund short, CTA short, you had a lot of positioning lined up that any little catalyst would have got some covering to take place. Okay, so we felt comfortable about the low being the low for now. It was how much upside, right? What's the reward side of that equation? And the answer to that was, what happens here? okay? Because if financial conditions continue to tighten into that squeeze getting started, it would have capped it to a lot less than what we've seen, more than likely. Instead, you had basically, right, and some other indicators aside from this are even more drastic. But what you've had here is, right, you see this, tighter conditions, and this is easier financial conditions. Okay, so kind of even you can look at it in an easier way to look at influx of liquidity or draining liquidity out of the market, right? And that's the big driver of equities these days. And why has the market been under pressure all year? Okay. Financial conditions, which were extremely easy, right? Looking from where we were COVID lows to here, right? One extreme to the other, they were aggressively tightening, which weighed on risk assets. Okay. So we had a little reprieve here. Now, fast forward to last week when we met, right? We acknowledged we had the squeeze. The Fed kind of got out of the way of that squeeze. Didn't have any effect on it in regards to financial conditions. Okay. The short covering part of this bear market rally is basically over, right? That's what we were talking about in the last week. And now what we're looking for is simply, was this just a breather, right? Just something where the Fed let the markets breathe a little bit because things were aggressively getting too tight. Was a lot of you mentioned the midterm elections being a primary reason, right? The Fed didn't want to aggressively tighten into the midterm elections, politics and political stuff, right? Makes sense. All these things you guys have been suggesting, there's no really right or wrong. We don't know unless you know Powell personally and you know these Fed members, right? But they could all be playing a part. Every single thing you guys have mentioned. So no one's right or wrong, all right? But what we're looking for now is, does this continue? Okay? Because simply what this will tell us is not even that the market will head lower or higher or is the low in or any of that. I think to look at it through that point of view is wrong because it can be misleading. I think what we're trying to get out of financial conditions is simply, is the market in a sense being rigged or not? Okay. And the reason why we want to look at it that way is because it doesn't necessarily mean, even if the market's not being rigged by the Fed to go lower, okay, it doesn't mean the market just is going to go into melt up mode and to new highs and start a new bull market, okay? But what it will mean is that the things we do pay attention to, sentiment, positioning, flow, right? The edge we usually rely on in normal market conditions will work again. Okay, that's the significance. Where if the Fed is rigging the game, okay, it really skews the reward side of the equation off those setups, basically to make them not even worth the play, right? Because your upside is capped and your downside isn't. And who the hell wants to take advantage of any opportunity like that? So that's the reason why we're keeping an eye on and keeping tabs to what's taking place in regard to financial conditions. Okay. So from when we last met last week, to give you guys an update of where we're at, there hasn't been any aggressive tightening. Okay. And what's interesting is we've seen Fed member after Fed member come out, including some of the biggest doves we've ever known in the Fed, Cash Carry being one of them, sounding as hawkish as they can possibly be. Okay. So some of the rhetoric, right? The mouthpiece of the Fed, which is used to control financial conditions, has been telling the market that they're looking to tighten further, but the market is not paying attention to it. Okay. And the reason the market's not paying attention to it is simply they think they're full of shit. They're saying one thing and they're doing another. Okay. And the market's interpretation is not even necessarily that they're just going to start cutting rates and we're going to see QE all of a sudden magically. But basically the Fed, okay, is pretty much done. Right? That's what the bullish side of the market, the way they're interpreting things right now, is that the Fed is done tightening. They've aggressively tightened already enough or too much for basically the majority of that tightening cycle is done. Okay. And think about this before you guys say, wait, they're not done. They're going to raise the next meeting. The market doesn't look at things the way we look at it. The market doesn't look at what's going to happen next week, next month. The market looks at what's going to happen from now, next year, right? You've heard it before. The market looks ahead. It factors in what's going to happen, not what's happening now. That's why everything we hear and see in front of us right now that everybody's talking about usually means nothing when it comes to this game. The market has already chewed that up, digested it, and shit it out, right? If we all know about, we're all talking about it, it's already priced in. Okay, so the market right now is looking ahead. And what it's saying is, looking ahead, they think the Fed is done. Okay, and not only done, that there's also the possibility, and you've seen the market price in cuts in 2023, that they may have over-tightened already, and the economy is going to get worse, and they're going to need to cut. Okay, so that's what's behind what's been going on now. Right or wrong, that's what's been going on. Now, you have tomorrow, okay, and you heard me just say, the market basically is saying to the Fed, you're full of it, right? Here's cash carry, all hawkish, you see some immediate price action, then you see financial conditions start to ease again. After cash carry basically sounded more hawkish than Volcker, for Christ's sake, okay? The market is not going to believe any of this lingo unless it comes out of Powell's mouth, okay? It's simple. Tomorrow, if Powell wants financial conditions to tighten, he knows exactly what needs to be said. Okay, he knows exactly. The last Fed meeting, same thing. He knew exactly what needed to be said for financial conditions to tighten. You know what happened in the last Fed meeting, the decision meeting? Okay. Not only did he not do what he was supposed to do in sounding uber hawkish, he had some dovish lingo in there, right? In claiming that he was already at neutral. So basically saying, we're there, we're done. Okay? Again, he's not saying we're going to cut rates, but he's saying we're at a level where we're close to pretty much being done. The only thing is we may keep rates there for a while. Okay? But again, that tightening, aggressive tightening cycle, that means it's over. Okay, so everybody tomorrow, and that's why the market doesn't believe all this lingo and all these words that are coming out of Fed members' mouth over the last couple of weeks, because they said, you blame them? The way they're looking at it is, we heard the same shit, and then you had Powell come out at the presser and say he was at neutral. Like, what are you doing? You're saying one thing, but you're doing something completely different. So now, okay, tomorrow he could set the record straight. Simple. He could, okay? And that's why we've seen a little bit of quiet with a bullish bias, obviously even today ahead of that, because we're going to see tomorrow, we're going to hear with our own ears, and we're going to see with our own eyes how financial conditions react to that, okay? Again, all the stuff that people are concerned about, right, and all the stuff people think the Fed should say tomorrow is one thing, okay? The problem is everybody thinks that, everybody has been positioned for that. And what usually happens in the market is the total opposite, right? We see it time and time again. All right. Everybody but the price action and the financial conditions have been anticipating a hawkish Powell tomorrow. All right. It's simple. And we're gonna, the proof is going to be in the pudding tomorrow. We're going to see it. All right. We're going to see it. So, and again, I want to stress, because if financial conditions do not further tighten aggressively, right? If we don't see that rigging process in play, we still have an economy that's going to go through a very rough time. Okay. You still have some negative forces at play that are going to exist for this to be potentially just a bull market rally or a range bound market. Okay. It means nothing. I told you guys, I've been in this game 25 years. I've been in markets where the Fed has been aggressively cutting rates and this market couldn't catch an effing bid. So it doesn't mean that the market will go quickly into melt-up mode, okay? But what it will mean is the other stuff that we pay attention to, okay, matter again. They mean something again, all right? So example, we see another setup like we saw into the recent lows, okay? We can feel comfortable about taking a shot, rolling the dice, and placing a bet on a decent sized rally off that setup. Okay, because it's not going to be affected from what's normally affected. And that's kind of what Tony P from Goldman says in a more elegant way, is basically the same thing. The thing that day trading the financial conditions, which was what it looked like the Fed was doing, really. It looked like really that's exactly what they were doing. They really wanted to keep a lid on things, okay? It doesn't look to be the case any longer. You see, that's what he said. The Fed is no longer day trading the financial conditions index. All right, see, it's still the transmission mechanism for their policy, and things need to tighten from here again, but they aren't going to get in the way of any little rally. They're not going to be so eager to get in the way of any little reprieve. They may even welcome it more. Okay, so there's not as much damage from conditions further tightening, right? So I know we spent a lot of time on this. It's been the most important thing, in my opinion, and that's whether you think it or not. Everything else didn't matter, guys. It really didn't. Again, I don't know how much proof you guys need. You know, you can look at all the macro stuff and charts and everything you want till you turn purple in the face. You know, you can look at sentiment, you can look at everything you want, okay? It did not matter. It's not a coincidence that this, okay, is the inverse mirror image of the S&P 500. Not a coincidence, okay? Not a coincidence, right? Almost to the point it looks mechanical to a T. Think about how difficult that is to do with the makeup of stocks. They make up the indices. So all the other stuff didn't play. Think about it. It didn't, right? We heard all this thing about QT being put into effect, right? Now the same thing. We're worried about QT again now. But the same concerns were around, even if they were starting off slow a few months ago, okay? But all that mattered was this. Okay, all that mattered was this. But listen, Eric, you can disagree with me all you want, right? The stories and what you think and believe. Oh, I'm sorry, Eric. I just saw a disagree on that. I thought you were talking to me. I do that a lot on here because I can't see everybody chatting. I apologize. I apologize. But again, I'm not belittling anything you guys are looking at. I wouldn't have the audacity to say something is not important what you use and you have confidence in. I'm just saying the time we were in, these things didn't matter. I'm telling you the stuff I have confidence in didn't matter. Okay, all that mattered is this. All right, so if we break that mold in a sense, okay, that's what it means to us, that the stuff that we rely on to usually work will start working again until we see this stuff that get back into play. You understand? You know, no, we never looked at any of this stuff, right? Especially those of you that I know the last few years. The last time like we paid attention to a lot of this stuff were brief periods, like the end of 2018 for a little short period of time. You know, the 2008 debacle, this was big. The regular market conditions without the Fed, you know, being involved, you don't look at these things, you know? And honestly, prior corrections, it was simple. It was simple. You would see financial conditions tighten in all one motion. Aggressively, you would see credit spreads blow out all in one shot. You would see the price action in the markets be a complete debacle, and then the Fed would rig the market the other way, right? They would implement the Fed put, and you would see the opposite. You would see this and all that financial condition stuff fall on its face and become a non-factor again. You know, a non-factor. All right. So again, and you guys have heard this in the past, I don't think it's a good idea for us to focus on whether the bottom, okay, there was a bottom that was put in place. Is it the bottom? Are we still in a bear market? I think the answers to that are going to come as we get through this, okay? But trying to focus on it now, I think could only hurt us than help us. Why? Think about this. Even if the lows are in, even if I told you we hit bottom, okay, we could retest, right? And look how far away we are from those lows. Even if you felt like we did bottom, okay, you know how much pain this is? All this room here? You know how much pain is involved in there? And you think you could stick through that pain and you know, buy through it or hold through it? Easier said than done. Easier said than done. So what I feel we want to do, okay, and again, this is if tomorrow we don't see, let's say for example, tomorrow we see Powell come out all hawked up, right? He sounds as hawkish as ever, and we see the market believe that, then it's a different story, right? If we see financial conditions start to tighten off of hawkish Powell rhetoric, he might have reset things like a lot of people are calling for, okay? Then this is all moot, right? The point I'm trying to make is if the Fed is rigging the game, we don't want to be in the middle of that in any way, okay? Because a lot of things we use don't work. We're going to be lost in space. All right. But if we do see financial conditions settle down, if we see credit spreads just settle in and range bound instead of widening out, okay, what we want to do is these dips, that's where we want to look for opportunities. You understand? That's where we want to look for entries. And it's not even just the market. You guys remember we spent some time on this the last couple of weeks, almost preparing for it. I think it's even better we don't focus on the major indexes right now, okay? And the reason for that, I think we're going to see isolated names, individual names, catch different types of action than what we're seeing in the market as a whole. You understand? So we're going to see XYZ see aggressive accumulation, even if the market's choppy or looks abysmal on certain days. And what we're going to start to notice, and what you're going to start to notice are certain sectors, certain pockets of the market, groups of names that outperform the major indexes anyway. You understand? And the more action, the more names we see that catch that quality accumulation, the healthier and the higher the probability that this low is the low. You know what I mean? The higher the probability is. The more names we see involved, especially if we start to see, risk on type names, start to see accumulation, more and more of them, that's going to tell us a lot about the health underneath the hood of the market and give us an idea of whether this was the low or not, because we could, and a lot of you guys thought that it would probably play out that way, right? A lot of you guys, I remember telling me that your gut thinks it's going to be more of a range bound market than a big up or big down type market the rest of the year. I could definitely see that. I could definitely see that. And based off like where positioning is and sentiment is, that would make the most sense. That would make the most sense. You know what I mean? But so the playbook for that, if that was the case, the playbook for that is twofold. One, focus on individual names over the indexes. That's number one, okay, in that playbook. And number two is take advantage of weakness and forget about chasing strength like we were doing for the couple of years off the COVID lows. All right. So what I mean by that is not even market weakness, right? You see some rotation from, you see like the growth names, right? Sell off for a week or two or whatever it is, and they rotate into energy, and energy gets extended. You don't want to chase up energy after they're extended, right? You want to look for opportunities on the other side if they're seeing flow. So if you start to see growth names catching flow off pullbacks, that's where you want to look, right? Vice versa. You see FANG and a high beta and high growth squeeze for a week, right? They get extended and energy is in breather mode, or in commodities go into breather mode. You start seeing buying flow into commodities and energy off of that breather. That's where we want to look. You understand? And what that also will help is not better entries, right? That's the obvious. But if the market is range bound, you're going to be buying the names at or near the right neighborhood and be able to trade them and sell them in the right areas, right? Because if you're buying them here extended and you got to sit through this, obviously that's a problem, So that's the playbook for a range bound market per se, and if shit's going to hit the fan, guys, again, like if we're going to go just back to where we were basically up until this rally, what we're going to see is we're going to see buying dry up completely. You're going to see put sweeper activity just take over everything. You're going to see financial conditions aggressively tighten, and that simply is just going to tell us not to buy those dips. Right. And then get the foot in the bunker again, get the foot in the bunker again. So, it's an interesting spot here. And I think, and it makes sense because everybody's eyeballs are glued to the market as a whole, right? Everybody now, because of just the way, everything was highly correlated, right? The market went up, everything went up. The market went down, everything went down, right? So it trains everybody to focus on what's the S&P 500 doing and then go from there. Where here, the opportunity and the alpha, I think, is going to be in individual areas and individual names in where we don't have to rely on the market as much. And that's a beautiful thing, because again, you guys aren't used to that, most of you, especially if you're new to the game. There were lengthy periods of times where I was involved where I wouldn't even look at what the market was doing. Sometimes I'd forget to even look. I'd be like, what? Oh shit, the indices are down today. All the stocks that I'm focusing up on look good. They're strong today. They're up, right? Well, the indexes are down a little bit. And that's what you start to notice. Yeah, the thing with the flow is tough. Unless it's new names. Flow is tough to catch the initial stages on rotation. The trick with the order flow and the sweeper activity to pick up on rotation is off of pullbacks and breathers. That's where you want to keep the majority of your focus. Again, you don't have to necessarily wait for that pullback breather if you're playing really tactically, like you're being quick, right? Because you want momentum on your side. If you're day trading or if you're flipping names here and there, you want the momentum there already in the sense. But if you're looking to swing names, especially in this type of market, you kind of want to anticipate that. You want to anticipate that. So you'll see a ton of flow in energy names like we have, and commodity names, and you'll see the price action in these names. They've been doing well for a week straight, right? They look overbought on shorter term timeframes. That's where you want to start looking elsewhere, right? Looking to spots that haven't been rallying and catching the flow with all of those energy commodity names. And today is an example. Again, I wasn't around for early part of today, but just give you an example. Like up until today, all the good-looking action, all the real action we've seen has been in energy names. If you guys want energy names, I can give you a solid list of at least 10 that have been lit up with solid sweeper activity. You know what I mean? Good-looking flow. The problem here now, where we're at, is that because of this aggressive buying and solid buying that's come in, these names have moved a bit. They moved. Yeah, exactly. Right? We like to use the term cooked. So instead of getting the FOMO in some of these names now, what you want to start doing is looking elsewhere, right? Into what didn't rally, what didn't catch the flow, and look to see if action goes there. Again, somebody mentioned pins, great point, right? It didn't rally with the energy names, okay? And it started to see buying into, some quiet time. So that type of thing. And if you're stuck on just commodities and energy because you think they're going to be the new leadership in this market, I'm not going to argue with you. That's what the flow's been telling us all year. What you need to do then is just sit pat, right? You sit tight when these names get extended, where you likely sold them for a trade. Don't buy them higher than where you sold them. You're going to find the discipline to wait it out and allow them to at least breathe. Even if they don't come in price that much, at least breathe after some of these big rips. Some of these things have had crazy rips again. Rev, what am I hitting? Rev, not Rev. What the hell's that name? A couple of you guys liked it. Energy name caught some big action again yesterday. I drew blanks all over the place. But all these names. No, the vet. Thank you. So you see, like this. Yeah, this already lifting here. You don't want to get too crazy chasing. At least you want to see a little digestion, right? These little things here like that. And then if they see some buying, that's where you're looking again. All right. Again, I'm not going to argue with you that vet is not, that could be a new leader in this market. These things, if you look at fundamentals, anybody cares anymore, these things aren't overvalued in the least way, right? These things have been ignored for ages. Yeah, SU's at a pretty decent spot still, didn't rally hard. Some of these things more than that get, but you see it's still lifted a little bit here. You just want to wait for breathers, unless you're okay with sitting through some breathers. That's all. I'm not saying they're going to crash, especially a name like this that really hasn't rallied significantly. But you want to look, the closer you come to a rest, the better. And again, I think no matter what, even if commodities, energy are still the leadership in this market, okay, we're going to see, again, new names. I don't mean names you never heard of. I'm talking about energy names that we probably knew existed, but just didn't catch the type of action like an Oxy caught or like an AR caught. or like a CVE caught. You know what I mean? You're going to see names like a vet. You're going to see names like, hold on, again, I'm drawing blanks. Every time by the close, I'm drawing blanks. There was a driller, oil driller, that caught action that I didn't even know existed. It came public not too long ago too. Hold on, let me think. A new driller, 3 letters. Anyway, I'll think of it as we go on here. You know, so that BKR is Val, right? Val, is that it? Yes. This is it, right? Yep, this is it. You know what I mean? So again, just caught one bet, right? But honestly, I can't remember if this thing caught any action, especially like the bet it just caught. I think they opened the largest position in open interest recently, right? So this is like how names like AR started. AR, we never saw action in. AR was a cheap little stock, never caught flow. Now these things get lit up. This AR seems like it catches flow every single freaking day. You know, every day, right? The Tepper name still catches these missiles, EQT. You know, so, and again, this wasn't a name that caught a lot of flow. Again, probably not a name that Tepper was looking to build a position in. But if they're the new leaders, Ensco, I remember that. That's what it is? Okay. Because I don't remember hearing about an IPO of this or anything. I know the old Ensco. Thank you for mentioning that. I know that. Yeah, because I sort of just started trading here. So that's the reason for it. That's the reason for it. Right? So and you get a good idea with the flow of even momentum. Like I give you an example. You're seeing more energy names catching the majority of the good looking action, then chances are, you know, energy is going to play a leadership role no matter what, through the chop, through a rally, whatever it may be. So there's going to be smoother rides in the groups that catch the better flow, right? Doesn't mean the others can't work out, but they're just going to be smoother rides where they're buying the group, right? Like for example, pins, you know, it's not like they're buying pins and Square and every other name in the same manner. They've just been focusing on pins, you know, on Pinterest, and probably for a reason. You got Elliott involved. You know, I don't know the news if it mattered today. By the way, that's what those algo sweepers were trying to sniff out yesterday in Pinterest. Remember we were talking about those algos? What the hell were they buying? You know, those cheap weeklies? That's probably the news that came out today they were sniffing out. So, you know, these are going to be tougher trips. What I mean by tougher trips, the upside, you're going to have to sit through shakeouts more than likely. Because again, the wind is not at its back. The whole group is not being bought up. It's just stock selective, right? Pinterest, likely because Elliott's in there. That's why they're buying it, right? Likely Elliott doing the buying, for crying out loud. So it's more stock specific. But you start to see, you know, we start to see the type of flow like in Pinterest, or the type of flow we're seeing in, you know, the ARs of the energy names of the world. We start to see that type of flow in high growth names like the pins in those sectors. That's going to be a really bullish signal for these groups. You know, it's going to be extremely bullish. And it's likely going to happen at a slow pace. It's not going to happen all at once. Again, well, that's my gut feeling on it. That's how it usually happens when you get through bear markets. But I could be wrong. You know, you just want to pay attention to it. Even if you miss the first batch. I always miss the first batch. Always. Always. You know, the first batch of names that start to catch action, because I'm suspect of it. You know what I mean? I think it's just stock selective. I think it's going to be a difficult trade. And I usually have a tendency to stick with the smoother ride stuff. Okay. But once I start to see the stock selective type flow become more than just stock selective, I'm going to take notice no matter what I think, you know? So you have to pay attention no matter what. And if you're paying attention, you can't miss it. You really can't. You know, you're going to see and you can't miss the energy buying that we saw this year. Actually started last year, right? Started last year. Like coming out of the summer last year, you could have missed it, right? You could have been suspect of the energy buying. A lot of us were, but coming into this year, you have to be, you have to have a blindfold on to miss it. All that action, you know? So it's not something you got to be worried about or concerned about missing. All right. So again, even that's why I don't want to get fixated on the low or not. The most important thing to me is if this mold and trade or financial conditions breaks, right? If that breaks, even if it's a period of time, we can utilize the tools that we normally utilize to make some money, even if it's, again, a shitty market as a whole. You know, and I'm telling you that when you're focusing on names, it's not easy to do unless you're aware of it and reminding yourself, because you're going to hear even the rhetoric around you. Oh, this market's a disaster. Chop. Both sides are getting destroyed. Premium drain. All the lingo you're going to hear, right, during choppy markets. But again, underneath the hood, there's going to be some decent opportunities. You know, short term, longer term, depending on the flow, but there should be some decent opportunities in individual names, and that's something different, something we haven't seen up until recently. Next, that's another good one, right? Next, that's an energy name. You know, these have been good looking stocks. You know, they've had big runs. Nice breathers, right? They were supposed to have that. You know, you don't want to see a rally like this continue anyhow. You want to see a nice breather. And then you start to see flow again. That's when you revisit if you're interested in these things. But they look good. Anybody have any questions as far as that, what we went over here is concerned? All right. Again, I know it's a little much because I went back reverse to what we were looking at a week ago and tied it into where we're at now. But tomorrow we're going to get some important information. Anti-VIX is just shy of sell. I posted it to private Twitter if you want to take a look. Just shy. Sharpie update tomorrow. Yeah. I don't. Yeah, I can't say it's not as important. Every update's important. But obviously what you want to see is you want to, if for bullish purposes, you would want to see Sharpies still all in, basically. I really believe you're going to see riffraff cover some of that short position. I think tomorrow. They've had a lot of pain there. No, here. Just so you guys see, look. They actually added in some areas, Tony. They added in some areas. So here. And this too, this has been, again, if you think about like comparison to the last bear market rally that was the real bear market rally back here, right? They weren't even short the riffraff, and they actually bought into that rally. So it was a lot different than what they're doing here. I mean, this is crazy. Again, I think this is a big reason why Sharpies are so aggressively long. I really do. I really do. It's crazy, right, Eric? Crazy. Hartnett, we're going to hear from tonight again. He don't think, quote unquote, the lows are in. He's not totally sold that we just fall apart so quickly again. He thinks it's a possibility depending on the economy and stuff like that. But he thinks we could be more range bound until we get that final capitulation. like HeartNet, what we were talking about, the reason why, the main reason why I don't think the low is in is kind of what is bothering HeartNet. Well, that and some macro stuff. We didn't see fund flow capitulate here. As a matter of fact, they added inflows, right? Yeah, so that's a risk. That's a risk that usually, like I told you guys, the final stage of a bear market where it puts it dead. And you've heard the line before, no more sellers left. That's when you see fund flow capitulation. That's capitulation, right? That's the true definition of capitulation. There are no more sellers left. That's what creates a bottom. That doesn't apply right now. You got, like you guys are pointing out, a couple $1 trillion of inflows that if the economy deteriorates, which is a likely possibility, right? And it weighs on the market as well, they're going to come out $2 trillion worth. Okay, they're going to start selling. Right? HeartNet brought up a great point. What happens when unemployment ticks higher and they lose their jobs? Right? That didn't happen yet. They haven't had a reason to sell. You know, they haven't had a reason to sell. They still have jobs. They're looking to wait it out. Right? And you see it in a lot of the speculative things out there, right? The meme stocks catch fire again. Bitcoin had a little moment. Ethereum, you know, there hasn't been the end of a washout like you would want to see. All right, but that doesn't mean this low can't hold up for a lengthy period of time. It could, you know, it could. Just if you go by the playbook, the bottom usually doesn't come into play until you get that. Yeah, right. The job market's strong, right, X? So if you have a job, your investments are maybe underwater a bit. You're not in a rush to sell, you know, but you lose your job and you start to see some bleeding in your funds, you're pulling the cord, right? So we haven't seen that yet. We haven't seen that yet. And that's why, guys, like I told you this the last couple of webinars. I truly believe, I could be wrong here, but I really believe with what the Fed has done with rates, and if they ever get QT into motion, it's going to have a real effect on the economy. I know it has in certain areas. Real estate market is cooled, manufacturing has cooled, but that's not even from what we've seen out of the Fed recently. That has a big lag effect. You see, like in my honest opinion, you want my honest opinion? I think it kind of got pushed into next year. Everybody was expecting it to happen now. And I think it's kind of got pushed into 2023 a bit. Yeah, maybe, you know, maybe. So, but think about that, okay? If it did indeed get pushed to 2023, all right, you got some decent time from now till then, right? This low may very well hold up, okay? And we trade in some sort of range up until, you know, first quarter next year, and then we go and break new lows, right? And that's where you see fund flow capitulation. What is that? Is that so impossible to think? I pray it doesn't. That's not far-fetched at all. That's not far-fetched at all. You know, it's for the market to go and break lows now, it's gonna need a lot of help. It's gonna need that exogenous event. Something's gonna have to break out there, in my opinion, for this market to just go whoop and accelerate to the downside. And the reason I say that, on the professional side, right? We've been talking about retail and fund flow. The professional side is really bared up. Like they're really cautious. Okay. They've been gradually getting more and more cautious through this whole period. It hasn't been like normal corrections where it happens, boom, and it's there. This has been a slower pace of the pro side getting bared up, right? Like, and here's a good example of it. We look at hedge funds. Okay, this is not updated, right? Is it? No, oh yeah, this is updated. Here, this is what I'm looking at, okay? So you had hedge funds here. You see how this is really like choppy? Here's the zero line, okay? Right? They were reluctant to really get aggressive on the short side, net short. They were actually living up to their name, hedge funds. They were short, let's say some growth, and they were long commodities, right? They were hedged more than aggressively having a bias. And that changed here, right? Into the selling. You could see it changed. Okay. So this is where they actually got short, along with CTAs and a lot of other professional measures, more of the pro side. And then they got squeezed here. But look what they're doing already into a couple of days of selling. Look, right? They started shorting again. They started look, they get back to zero and boom, they dip in the short side, right? And coincidentally, we get a big squeeze today. So that's why I think it's really difficult for this market to really find that sustained momentum to the downside and break lows. Because they're already, that's what these guys are positioning for, right? And like CTAs, which they're more of a trend following systematic group. A lot of them go off volatility and VIX and all that, but you look at where they're at, and the bulk of them, I would say, covered shorts and got to neutral. Some of them are still short. Like, this is from TD. Look, they're still short coming into today. This was the last update. Here's what it looks like on a chart. See, they covered a little bit, but they're still short. So yeah, now that's the thing. In normal market conditions, coming out of a correction, okay, where the Fed is not playing a part on the other side, usually they're on our side, right? We would get long and stay long until these guys got long. There's no reason to ever sell until they get long. Okay. But because of the macro backdrop, because of what the Fed is doing, okay, they're more reluctant to chase, right? They don't want to chase because they're fighting the Fed. All right. If that changes, it's a different story. Okay. But that's why normally, like, I'll give you an example. You see here, you see how even this was even more of a quicker cover, and you see how they got long from short. Like here, the short's been building and they don't want to get long. So two things. Praveen makes a good point that if the market does head higher, you will see them chase, right? If the market moves against them, you will see them cover their shorts more so till they get to some sort of even small long position like here. Okay. But I think what's even more important on the downside, okay, unless you get that exogenous event that prevents them from covering, what you're likely to see is them cover some of those shorts into weakness. So you get a couple day pullback, you get a bounce, they're luckily going to cover into that bounce a little. You know what I mean? And that's where you get days like today. So, and what that ends up equating to in the price action is more chop range type thing. Yeah, that's what it. So the professional side, unlike the retail side, the professional side has been a lot, significantly more bearish, significantly more bearish. And for good reason. They pay more attention, right? They're more market savvy. I'm not belittling Refraf. There are a lot of retail traders that are smarter than pros, but as a whole, the pros pay more attention to macro, more attention to detail. And obviously, if you do that, you can get pretty bared up right now, where retail, you see what a lot of them pay attention to, momentum, short positions, short exposure, stuff like that. Apes, I don't know what the hell they pay attention to, but you know what I'm saying, and another thing, like even in the futures market, you want to see, look at this. So this is hedge fund positioning in S&P 500 futures. So again, like Praveen's point, like look at this, right? When you had the Fed pivot and they were short, they would have to flip to long, and that you're going to see that in the price action. So for the market to really take a spill and for them to cash a ticket on this, very unlikely. Very unlikely. What's likely, even if the market's headed lower, what's likely to happen is this gets worked out through chop. Yeah, and that's what they do. They wait for them to get all in, and I mean, look what they were doing. They were buying this dip. Not only were they long, they were buying even more on the first dip, and they got run over, So they decided here now, it's amazing, but they decided here to get short. There's no take. This is bullish. Okay, this is bullish. You can't make a bearish case out of this. All right, you can't make a bearish case. So that's why I'm trying to get the point home to you guys that the Fed, the last thing the Fed wants is a runaway rally. Okay, they're going to try to prevent that from happening. That's the last thing they need. They really can't have that. Okay, but they might be more looser when it comes to allowing squeezes and some reprieve in financial conditions. All right. And again, I don't think that's a bad thing for us. I think, listen, we all want to be traders, stock pickers. I think all that stuff that was a waste of time from basically, the COVID lows, let's be honest, you could have thrown a dart. You didn't need to really do any homework, up until now where everything moved with the market for the first time in a while. I think if you put in the work, you pay attention, right? All right. What names are catching a decent action here? They've been, consolidating. You got a decent setup here. Like if you're paying attention to that stuff, your entries, your exits, it could be a decent time. It doesn't have to be that bad. Andrew, why wouldn't they want what? Oh, because of inflation, Andrew. The last thing they want, okay, and you've heard Powell say this over and over, every Fed member, is a 1970s type situation where you got a mission accomplished, all clear, start of a new bull market, and then inflation flares up again in a big way. They do not want speculative stuff flaring up again. You know what I mean? What they want is risk appetite to remain tame. You understand? They want to cool things down. They want to cool things down, right? So their soft landing scenario is to have things cool down, okay, as far as the economy, markets, risk, everything, just cool down, but not break. All right, that's their ideal scenario. They don't want something to break and things unravel, and they don't want back to where we just came from. The LQDIEF, is just, without getting into too much detail, it's just one of the few things, especially if you don't have a Bloomberg terminal in front of you, to get an idea on how financial conditions, the makeup of it, rates and all that, are doing that particular day or days, right? So I'll give you an example. Ooh. Let me get this out of the way here. Okay. So let's say financial conditions start to aggressively tighten off of Powell. Okay. You're going to see this LQDIEF head south. Okay. And when you see it, let me pull up. Oh, this is a daily. Okay. So when you're seeing this do this, it's kind of where the upside in equities, it's not going to happen. It's not going to happen. You know, a lot of us have been playing off this for the last few weeks, even intraday to a T. I wouldn't get too hung up on that because that's not what this is for, even though it's worked so efficiently. It just gives you an idea of how financial conditions may be for that particular day. That's how I use it. So like I give an example today, right? Yeah, the market was up, then it retraced, then went up again. You know, as a whole, where's the 20? Oh, here it is. Like you, for the majority of the day, you had this telling you what, oh, here's my pen. And, you know, it remained, conditions were on the easy side. You understand? Normally into a market, into a rally when the Fed was rigging, you know, like we talk about the Fed rigging the game. So that in simple English, that means tightening financial conditions. You would see the equity indices gap up or rally, and you would see this thing just head south right into it. And then you see the markets follow. You understand? So tomorrow, let's say we go green into Powell. Okay, when's Powell speak? What time? I don't even know the time. Anybody know the time offhand? 10. Okay, that's actually good. I like that better than pre-market. All right. So let's say we see a follow through in the rally into Powell, right? They're calling the bluff. If you see during the Powell speech, this, you know, start to aggressively head south and turn down on the day and just continue to go, that's, you know, that's giving us an idea that rally's likely going to fall on six. You know what I mean? The upside of this is not the same. In other words, this doesn't need to go up for equity prices to rally or hold up. All it's got to do is hang out here for it to be kind of bullish in the sense. You know what I mean? So don't get hung up on this not going up in equity prices are. That's okay. You know, I'll give you an example. This will give you a cleaner picture so you understand what I'm talking about. The thing we just looked at, the credit default swaps, just to give you an idea. Ooh. Ooh, is that it? Yeah. Okay. Of course, I chopped this one off. Wait, I'll get another one. Hold on. Here we go. Okay. You see here? Okay. This didn't go lower while the rally started. It started lower, but then you see how it just hung out? All it needed to do was just hang out. Right? Spreads just didn't need to widen out for the market rally to be okay. Once they started to tighten, right, and spread started to widen out, that's when it had an impact on equity prices. I hope that, you know, it's harder to explain. It's easier. The more you look at it, the more you'll understand it. You know what I mean? The more you'll understand it. All right. So you see like credit spreads are widening out here and it weighs on equity prices. You get a little reprieve here, opens the window for a squeeze in equity prices. Credit spreads start to blow out aggressively again, weighs on equity prices. You get a little breather here, opens the window for a little squeeze. They blow out aggressively again, new lows. Then you get this downtrend here, right? No new highs for a lengthy period of time, and it allowed this rally to do its thing. So the point I'm making is, if you see this, right, off of Powell tomorrow, we got problems. This updates every night. This updates, if you have access to a Bloomberg terminal, you can look at it during the day. Bunker time, you know? Again, this will mean nothing, Moses, when we finally bottom and the Fed starts to cut rates or whatever. Because what you'll see is a crash and death. Let me see, I might have a chart to show you. Hold on. So this, like Praveen was saying, this stuff didn't matter. You know, this was a waste of time to look at up until this year. Don't I have a private Twitter? So I wish I had another chart blown out even further, you would see. Because the Fed was implementing QE, right? Buying mortgage-backed securities, rigging the game in a bullish way, credit spreads tightened aggressively and remained low, okay, for a lengthy period of time throughout the whole rally, the whole bull market. And then, again, you think this is a coincidence? Right? Do you think this is a coincidence? I mean, come on. Right? Prior to this, it was a dead heartbeat. Dead heartbeat. After COVID, it blew out from up here, came down, and it was just a dead heartbeat down here. Then it started to come alive, and you know, look what it's done. All right, and if you back test the credit spreads, you know, the market has a real tough time when credit spreads are widening out. Real difficult time. You know, so think about it, like you don't want, on the long side, it's very simple. You just don't want to be a part of that, right? Why would you want to be a part of that? Right? You don't want to look for opportunities. You want to sidestep that completely. And you know, that's why I bring it up to you guys, not even to short into it, to sidestep it. Like if you're seeing this go on, you don't want to buy any of these dips, okay? Because the likelihood is, you know, every rally, the algos are going to sell right into. Any little rally, the algos, boom, 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 you know, sell right into. So this, again, allowed for this. You know, again, I want to put the disclaimer, this is not magic and it doesn't work in all markets. All right, it works now. Again, when the Fed ultimately cuts rates or implements QE4, whatever we're up to, this is going to become completely irrelevant. You're going to see it crash, right? And you're going to see it a dead heartbeat down here. Because you know what this measures, this in particular? Okay, these credit default swaps. Companies go in default, right? As spreads widen, the credit spreads, that's a higher probability of default. Okay, when they're tight, right, it's a more healthy credit market, less likely to default. So think of it. We had COVID, one of the biggest disasters, pandemics in our history. Okay, credit spreads were at their tightest levels ever. Did we see any bankruptcies? It wasn't a bankruptcy. You're not amazed by that? Think about that. The global economy shut down like a switch, and there were no bankruptcies. That's crazy, isn't it? And that's what this measured. That's what this was measuring. Right? Even with New York City tumbleweeds going across the streets and not a soul to be found, everyone locked up in their apartments. Okay, credit spreads were, because the Fed rigged the game, tight as they possibly could be. And for the simple reason, how do you go bankrupt when you have access to unlimited capital at zero interest rate? Right? Silver, you're going bankrupt? How much money you need? No interest. Don't worry about it. How do you go bankrupt? So that's now, right? Interest rates go higher. Right, buy now, pay never. Exactly. Interest rates elevate, right? Credit becomes tighter, right? The banks are a little more picky to who they want to lend. Payments go up on rent, mortgages because of interest rates, right? You got to have a higher default rate. And that's, that's what a lot of people, again, me too. It's hard to see unless the Fed pivots, in a very drastic way. It's hard to see a period of time like that not coming. Okay, and that would line up with the bottom. The low usually comes when the economy looks its worst out of bear markets. Usually, not when you see the light at the end of the tunnel, when it looks as bleak as it possibly could look. There's no hope in sight. Again, you think of the COVID lows. Even with everything I look at telling me to try your hardest to look for opportunities and be bullish, it was still so extremely difficult. You know what I mean? Seeing what was going on around me, how scary it was. I don't really feel that way now. You guys feel like that now? I really don't think we've had the cleansing we need for the low. Again, that's just me, but I don't know how much that matters to you guys or should matter, because it only tells you so much. We could rally higher. We could rally for longer. Even if it's not the start of a new bull market, there still could be more upside and the lows don't get tested for a while. So telling you this, I don't know how much it matters, but for the bear market to be over and the start of a new bull market, I don't see it, guys. Yeah, I don't see it. I don't see what you normally see. Yeah, spec position still pretty sure. Yeah, Galib. I feel like this rally, I understand it totally. I'm not befuddled from this rally. I'm not confused about this rally. It makes total sense to me based off how people were positioned. Total sense. And being a significant bear market rally, even lasting longer than it now would make total sense to me based off positioning. Total sense. But being, again, the bottom and the start of a new bull market, I'm just not seeing the things you usually see, in the flow, in fund flow positioning, like we spoke about. A lot of what we're seeing on the professional side is definitely there, but not everything as a whole, not everything. So, but this rally could definitely last longer. Definitely. Especially if, like we said, the worst of what a lot of people, including myself, thought we may see towards the end of this year gets pushed into like 2023. It would make sense. And think about it. At the end, right? If we continue to not even rally in a significant way from here, but just more of a bullish phase from here, right? Where dips get bought, it's choppy, names look better, just not as bearish as we've been seeing. Think about how many bears will capitulate, how many bulls will start to believe and get reeled in. And that's what normally happens from these type of bear market rallies. It's so tricky. It fools everybody. It fools everybody. But we'll see, I listen again, I could be wrong. We're in times that, you're hearing a lot of, we've never seen this before, or the market never did this until now. We're in different times now, guys. So you got to have an open mind and, keep your eyes and ears open to what you see every day. We see credit spreads plummet, crash, meaning they're tightening up aggressively. Even though we're not seeing a Fed pivot or anything like that in front of our face, the stuff that matters more is telling us that it's coming, So you have to pay attention to this stuff. Same thing with like the sweeper activity. If we start to see risk on names get lit up, I can't be sitting here, well, I still don't believe that the low, you know what I mean? I can't do that because I'll miss everything. You understand? So this thing can prove me wrong easily. But right now I'm saying what I'm seeing from the stuff I pay attention to, it's not all there. But like you guys are pointing out, you still got a lot of bearish positioning, huh? I mean, look at that chart I just showed you guys. Let's see tomorrow. I think they're going to cover tomorrow if they don't. I don't know what to think anymore. I don't know what to think anymore. But you had even this here. Let's look at this too. Hold on. So this is where Goldman, all the sentiment indicators are. Okay. So, not much of a move, a little bit of a move, more towards neutral. Okay. Usually at the bottom, this thing will be over here with everything floored. What's holding it back? What we just discussed. Look at that. Like that's the only thing measuring risk on, basically. The only thing, the fund flows. The complete opposite of what we're seeing everywhere else. Crazy. And usually this is here when the bear market's over. That's that's the real definition of capitulation. There are no more sellers left. Okay, that doesn't apply right now. There are sellers left, and it's in the fund flow. Where is here's like some other positioning indicators from DB. So here we're here right now, as of the start of the week. This updates again this weekend, so we'll see. But you know what I mean? Like if we get a little weakness, this will probably be over here again. You understand? So that's why I think it's got more to work off. And you got to see did I put the professional side of this? It's just nutty. Where is it? Wait. Discretionary, systematic. Oh, I didn't put the futures on this one. So you see like systematic funds, the blue line, right? They've been a lot more aggressive on the short side. And futures positioning, that's kind of like what we're seeing in Sharpie riffraff. You have COVID lows, even worse than the COVID lows, bearish positioning into these recent lows. And they're still there. So it wouldn't surprise me that this bullish phase continues for a bit. Any other questions regarding all this? So far, great questions. Fund flow won't sell until it has a good reason to sell. Like what? Jobs? You think job losses? No, I'm not. I'm not saying they're going to sell now, X. I'm thinking once unemployment starts to tick higher, that's when you're going to see fund flow. So, you understand? If the market's shaky and they lose their jobs, that's when you see. how you got to understand X, this has been really different than most bear markets or correction. You got full employment. Everybody has a job. You understand? Like, so think about it like, put yourself in their shoes. Okay. You have your investments, because these aren't tactical players, X, like us. They're not paying attention every day to what the market does. You understand? So when they get shaken out of their investment goals, usually is when they lose a job, things start melting around them. You know what I mean? They see now their IRAs down significantly. Now they don't have an income. That's when they sell, right? And it's almost always near the bottom. They never get out near the highs. They always get out at the end, just like they get in near the end. Do you realize, X, that there was hardly any fund flows for several years, inflows, until last year? Last year, they started coming in, late last year. As a matter of fact, December, January was that big spike in fund flows. You guys remember? I don't know if you guys remember what we were talking about that. We were using the same thing we were talking about, but just the opposite, if you remember. We said the bull market can't end until the fund flows come in. I don't know if you remember those conversations. That's what we were saying, okay? Because they weren't coming in. They came in, and then the market rolled over. You understand? That was the final chapter of a bull market. A lot of times it's the fund flows coming in, right? It doesn't have to be that month, but once the fund flows start coming in, you know you're near the end. That's usually the final chapter. Oh yeah, and Lourdes, I mean, that's a great point. All right, I'll leave you guys on this point, okay? Lourdes, good call. That's from Bulwa Hartnett, okay? So you guys get an idea. So you get an idea of what's been going on with fund flows, okay? Think about this now, what I'm going to tell you. If you don't understand, please let me know so I can explain it, okay? In equities, for every $100, Lourdes, for every $100 of inflows, fund inflows, okay, you know how much has been pulled out? $2. It was $4, but now because they put some money in, $2. So $2 out of every $100 that just came into the fund flows have come out. $2. It went down $2, Lourdes. Okay. That's not capitulation. Now I'll give you an example. The credit markets, okay, the bond markets, they saw capitulation. For every $100 that went into bonds, you know how much of it came out? 85. 85. That's capitulation. Equities didn't see capitulation. Now, you know, one of my buddies made an argument. I really didn't have a rebuttal for it. What about if the capitulation was in the bond market and not the equity market? Honestly, I don't have an answer to that. I mean, could it be just in the bond markets and not the equity markets? The bond market saw the capitulation this go around. You understand? So that reason, again, that's why even with the fund flow not capitulating, I'm still going to keep my eyes open for new names, new leaders, new flow, and bull market characteristics, because maybe it's one of those unusual cases like many others we've been talking about these days. A lot of unusual shit going on. You know, yeah, there was. That's real capitulation in the bond market. No doubt about it, guys. No doubt about it. Like, that's the definition of capitulation. And another thing, like, let's say you break down sectors, okay? Certain sectors even saw capitulation, or a form of it, I should say. An example, financials saw some capitulation, as opposed to, let's say, tech. All right, so players capitulated out of their financial holdings but not necessarily the other groups. Here, it's right here, what I'm telling you. Harnett worded it perfectly. So for every $100 since January 2021, okay, of inflows, just $2 of outflows, just in case you didn't believe me, from stocks. Okay, and here's what he says: everyone is bearish, but nobody has sold. That's why he doesn't think we bottomed. Okay, and then underneath that, what I just told you guys here, for every $100 of bonds. Oh, this is the Fed. Look at this. For every $100 of $100 of bonds, the Fed bought during COVID, right? By rigging the game, they bought bonds. They bought $5 trillion in total of bonds during COVID. They just sold $2 worth. We talk about like unwinding QT. For every $100 of bond rigging they did by buying bonds, they just sold $2 of the 100. So they didn't even do shit yet. As far as unwind. With inflation, of course, to be 5-6% next spring, QT is likely to be stepped up significantly in coming months, which would be negative for what we just talked about, credit spreads, and that means negative for equity multiples. You know? So you see, like, same thing, he's like, and he's been saying it for a while though, guys. SPX greater than 4,500. He thinks the Fed has to do the opposite of what they did in COVID. They might have to throw in the kitchen sink in a bearish way, you understand? To prevent rallies. So kind of the wind at your back type of thing. So again, to simplify everything, guys, a lot of us like to look at all this stuff in detail. It's interesting shit, but to simplify things, what I would plan for and anticipate is more of chop, range bound type market than anything else. And I would look for opportunities in individual names. And that's like the playbook. That's what I would use initially from here. And then we'll, again, that's why we do this weekly. Members, we talk about it daily, but then see more and more information as it comes in, and we'll see. That's the beauty of this market. Later, Mike. The beauty of this market is, next week we could be talking about how I got 5-6 new software names we never heard of that saw crazy sweeper activity last week. You understand? That would be significantly bullish. That would be significantly bullish, or tech or medical or whatever it is. So that's why you can't build up too much of a bias. That would be great. That would be great, because it's the best of both worlds. You can perform in chop if the market's a chop, Lourdes, right? You don't have to worry about the market too much, and you're not missing out on potentially a rally if the markets are going to rally, because you're in the names anyway. So it kind of defeats, but get both purposes. So that would be great, but we'll see tomorrow. Again, I don't like to hype up these things. They're usually a letdown, but more the reaction to what happens tomorrow than the noise. I'm really curious about. I'm really curious because everybody is anticipating Powell resetting the market. That's what everybody's anticipating tomorrow. And what that means is getting the market to believe what they're saying. And he can do that. He can do that because the biggest fear would be the Fed loses control. You understand? Where the market, you hear it all the time, right? They lose the confidence in the Fed, lose faith in the Fed. That is the biggest problem. You could get runaway inflation, which may be a bullish thing for stocks, but bearish for real life. Okay? Right? That's hyperinflation. But that's if the Fed ever lost control of things. They're not there yet. Okay. But let's see tomorrow. Tomorrow's gonna be it's a fascinating day. Yeah, they do. Lourdes, honestly, I'm being dead straight with you. I told you before, I didn't think they would even do what they've done so far. I think they would have wimped out, like you're saying. Honestly, I didn't even think it'd get to where we are right now. Because they're so scared. But I agree. Yep, always a pleasure, Dimitri. I could talk shop with you guys forever. You guys know that. I appreciate you coming by. Again, we'll chit chat next week, and for members, we'll discuss tomorrow, obviously. All right, and Sharpie's tomorrow too. So we got a lot going on tomorrow. Wait, we're closed Monday? What's Monday? What the hell's Monday now? Oh, Labor Day? Wait, what's Monday? Oh, no, we're open next week. Okay, good. We're open. Have a good night, guys.